Hi, my name is Brandon Goldsmith, and I'm an investor-friendly realtor, multifamily broker, and multifamily investor here based in Columbus, Ohio. Today, I am talking about what the common mistakes are for new investors, both local and out of state. When you're buying your first property, whether it be something that you're house hacking, flipping, or just buying as a turnkey rental, there will be mistakes. Industry, this is sometimes what's called tuition, or just learning your mistakes at a price. This can result in a few different things, often mistakes in the numbers on the initial analyzation, or once you purchase the property and get into the weeds and thick of things. So the first thing that I see working with out-of-state investors and local as well is going to be underestimating expenses and numbers when analyzing the deal. So this is going to come in forms of vacancy, your overall monthly expenses of what typical maintenance costs might be, or just when you actually go to rent the property, that it's under market rent and you overshot the property and try to get the top end of the rent where you should have been maybe a little bit more conservative. The overall rent might be lower than you thought it was when you looked at online. Maybe the other properties are nicer and that's why they're getting a better rent or larger, and overall expenses, especially if you're buying an older home or an older multifamily property. These things do come up, especially in forms of water damage, gutters, and then if you have old electric, old plumbing, and especially mechanics, those go out. Those could be big expenses. So just make sure, when you're conducting your research, you are having contingency budgets or maybe estimating a little bit higher maintenance cost if it's going to be an older home. So my advice on that is to just be a little bit more conservative when you are running the numbers. There are dozens of different calculators to be able to use and just ways to run your numbers. Consult with mentors and others who have been in the industry when advising on the first property. Also your team that you have as well within it, your realtor, contractor, as well. But you're going to want to budget for higher vacancies. Maybe, like I said, a little bit higher of CapEx costs or just monthly maintenance if it's going to be an older property. Maybe go for the middle route, if not a little bit more conservative on the rent. And because when you're looking at the comparable rentals, if something has other amenities or a garage or just overall nicer finishes, take that into account because that will go into play when you actually go to get your unit rented. So just make sure you're overlooking everything and double checking the numbers, if not triple checking when you're doing it on your first one. So another thing that new investors often overlook is going to be the location. A lot of investors get really caught up in the spreadsheets and see what looks best on paper or cash flow wise, and this tends to go with the location. So generally across a lot of markets, you can get similar rents based on the areas, but the prices may be drastically different. So if you're going to buy on one side of the highway versus the other, it may only be a $200 difference in rent or $300 difference in rent, but it could be a $200,000 difference in purchase price. So obviously the one that's cheaper is going to cash flow better, but there is a reason for that. Those properties could have higher vacancy rates, more crime in an area where it's just not that rentable, and this goes overlooked as well by picking the wrong area that just might not be in a desirable part of town or that property managers might just not manage. So make sure you're just taking this into account and looking at the overall situation based on the property. Obviously, you need to have good cash flowing properties, but maybe possibly consider sacrificing a little bit of cash flow for a little bit better of an area, one that you might keep a tenant in a little bit longer. And then again, everyone does have their own strategy, so that's just my word of advice. So when kind of picking a property, make sure you're not just going based on the property itself. Any renovated property will not get the same rent depending on the location. So do your research on the neighborhoods itself and pick accordingly. My advice for this, consult with locals, your agent, and others who have invested before, what it's like to own in maybe what's often called a C-class area versus a B-class area. Just pick accordingly because you are gonna plan to hold this asset, so make sure it's something you're going to want to manage and that your property is going to be willing to manage for a period of time. One of the other mistakes that a new investor might make is going to be over leveraging on the finances. So you want to make sure that you do have reserves set aside, not just going for the first person to give you a mortgage that says you can afford a home as an investment property. Make sure your credit is in check. You do have reserves set aside and you are not just trying to jump in just to jump in and get the first property. As everyone does want their first investment, make sure you are prepared and in a situation to buy a property, because if you have a mortgage with a high interest rate already on it and your tenant leaves and you have no reserves or nothing in the bank account to be able to support this, this is, going to be a very bad situation, and what is often called is over leveraging, and especially when this is done across multiple properties, and then that can leave you in a pretty bad situation if you do not analyze the numbers accordingly in the beginning, just are trying to purchase as much property as possible without having the proper plan or strategy set in place to be able to take on multiple. I would just get educated on the overall financing options, especially for investment properties, different products, and make sure that you have reserves set aside. And then when you're going after that first one, make sure you don't take on too many after that while still learning the ropes. If you buy 3 or 4 properties at once and make the same mistake as you would on one property, you might be making the same mistake on 4 properties at the same time, which can end up being pretty costly and just, maybe never make you want to invest again or ruin your investing career. So just be cognizant of this when getting started on the financing side of things. So number 4, so something that is all going to be strategy dependent, but focusing and buying solely for appreciation sometimes does not work. There's a sweet balance between being able to break even and ride the growth of appreciation in great neighborhoods. And some clients with higher paying W-2 jobs or just a lot of money in the bank account are willing to eat negative cash flow. But for new investors, unless you have a lot of money set aside, I wouldn't say this is always going to be the strategy you should go for. Make sure the property is at least cash flowing, if not at the worst case scenario, breaking even. This can put you in a difficult position if you're buying based on speculative values and banking on maybe a certain company to open in a neighborhood, or there's developments that were promised to be built that if they never pan out, and then you are stuck with a negative cash flowing asset that does not have any appreciation on it, is also another place that you can end up in a bad situation. So at least make sure in the beginning that you are breaking even, if not hopefully cash flowing a little bit, because writing negative value and negative cash flow every month can add up and start to be difficult, especially when repairs or any type of turnover comes in place. And this becomes a liability and not an asset at this point. So just be aware of that. On that note, I would just buy in good areas that are on the rise and do have all the data and stats to go up in value, but make sure that you're just not putting yourself with too much negative cash flow, where if any repairs or the tenant leaves, that you're not end up in a too bad a situation, or relying solely on one thing, if it's a business or a development to go directly next to that property, that you're banking on that before it even breaks ground. So don't over speculate, and make sure you're coming at this with a balanced approach to just buying in a good area with still some cash flow or break even. If you are negative, that's okay. Everyone does have certain strategies to it. It doesn't really work for scalability purposes to be negative on many different properties, but if you are getting your feet wet and being able to get those learning experiences along the way on that first one while being in a good area, that still is doable, but I just want to make you aware of that. Number 5 on that list is going to be lack of tenant screening. You could buy a great property in great condition in a great area, but have a tenant who comes in and completely ruins it, and this is because of lack of screening. You didn't check credit, you didn't check background history, and this is part of the reason why you might be now left with a $5,000-$10,000 plus renovation in order to now get another tenant and hopefully get this tenant there who is now staying, and you are making money on the property. There are many ways to mitigate it. It's from having a standard tenant screening process, or background check, or consulting with property managers. If you are not managing the property yourself, this can especially happen on if a tenant's trying to move in right away or just doesn't have a whole lot of information on them. Make sure that you have a standardized screening process or a background check of some degree, because you will need to mitigate this at some point. Mitigating this is actually a little bit simpler than people think. It is setting clear, definitive goals for the long-term, short-term, and property specific. So just make sure you're outlining what you're hoping to accomplish. If things do go south, have a good mindset. There are ways to recover from it. Just make sure that you account for the worst case scenario on things and bounce back from it, learn from it, and don't make the same mistake. So this one, number 6, is going to go hand in hand with the tenant screening. This is going to be, in general, poor property management. No one seems to ever like their property manager, but there are some good property managers out there, believe it or not. You're going to want to vet property managers if you are a new investor who is just getting started, don't go with the cheapest. Don't go with the first person you talk to. Understand how their systems work and what their operations are, how they lease properties, how they bill owner statements, what their maintenance fees look like. That's just going to be part of the game in getting started. And if you are managing your own property, this can especially take place. Make sure you have accounts set up. Make sure there is a portal for tenants to be able to talk to you, whether it is your number. Ideally, there is a separate line of communication, but make sure this is something that is at least set up where they know who to contact and when to contact you for maintenance items, emergency items. You can make a mistake on property management just as much as another property manager. And especially on the first property, you don't know what you don't know. So don't make costly mistakes. Make sure you're doing at least some research and make sure the property is in good condition. Maintenance issues can add up over time, end up costing a lot more. So that is just what I'm saying on that. Make sure you are just consulting with property managers. And if you're managing your own, do your research, get a contractor or handyman on board who you can call if you're not handy yourself. These will all save money in the long run and keep your properties in better condition and better organized in general. Number 7, I would say, is not having a clear investing strategy. So you didn't run your numbers very well ahead of time. You don't know if you're gonna do a fix and flip or a BRRRR or what the interest rates are gonna look like in 6 months. No one knows. So this is something that you really just didn't take into account. If the property doesn't sell quickly, this is all part of the investment strategy. If you go over budget on a fix and flip, or if it doesn't sell, can you keep it as a BRRRR? Can you afford to keep it as a BRRRR? Are the comps in the area relatively similar to what your listing year's at? Or are you trying to go for the max price and get the most out of it and hoping and praying it just sells? Because this is not always the case. Markets shift, things happen. So you need to be able to pivot and have a good investment strategy going forward. So know whether it's gonna be held for 2 years as a turnkey rental. If you're doing a value add, is it gonna be a fix and flip? Can you keep it as a BRRRR and afford to leave money in the deal, or do you need it all back out? Consider all these things, especially if you're going into a partnership. This is going to be vital in your success of owning and buying and selling and transacting real estate in general. Number 8 would be skimping on inspections and contractor bids. This is going to be on the value add side of purchasing property. If you're gonna do these rehab projects, don't forego the inspections. Don't go with the cheapest contractor because things always come up. Make sure you're analyzing those bids that you do get back from contractors, because is it gonna be a labor only bid, or does this bid include materials? These questions sometimes don't get asked. And this is important because if you're doing a rehab and it says $30,000, but there's another $20,000 of material that you just didn't account for that the owner's supposed to pay for, this obviously is gonna wreck your numbers and become a huge headache, especially in working with contractors on the inspection side of things, that if you're running your numbers very loosely and maybe didn't account for a few things, that furnace that's not working, or that sewer line that's cracked that you can't see, or the floor joists that are eaten with termites can add up very quickly and very easily. So this one is very manageable to mitigate. Make sure you're doing thorough inspections. I mean, if there's enough margin on the deal, maybe you just assume the worst case scenario for part of it and take it into account. And then for contractors, make sure you have a good, reliable one who's giving you prices up front. There are things that come up, so have a contingency within your bids, 10 to 20% contingency, because there will be mistakes and other things you did not account for to come up. You're just doing your best to mitigate the amount of money it'll cost you at the end of the day. Number 9, so this is going to be overestimating DIY or do-it-yourself projects. Replacing plumbing or maybe some electrical items might seem simple at first, and maybe you don't think it actually costs that much. But if you do it yourself and you have never done it, this is going to be something that can add up over time. Don't get me wrong, there are many things that you can do yourself and learn on YouTube. There are hundreds of videos, if not thousands, on a specific item. But make sure when it comes to more advanced stuff that you're not trying to save money, skipping on that, and hire some professionals for part of it. Mitigate this for plumbing, maybe hire a fully licensed plumber or electric. Make sure you're getting your electrician, because these are a couple things, for example, that might add up, that might not be do-it-yourself projects in the beginning. You can learn the things over time, but make sure that you're not costing yourself money by trying to save a little bit in the beginning. The exit strategy. So everyone wants to buy a property, rehab a property. Sometimes they want to sell a property, but not everyone discusses a clear exit and market conditions. Interest rates change, home values change, just make sure you're taking this into account. Partnerships change. One partner might want to have the property for a little bit longer. The other might plan to only hold it for a short period of time. So these goals have to be aligned and talked about and taken into consideration in the beginning. From the analyzation to the purchase, the rehab, the sale, make sure you're taking all that into account on how you actually plan on selling this property. If you want to hold it, for long-term, 10, 20 years in a great A-class location, or if it's gonna be a fix and flip, these are all things that need to be talked about. So these are all just a few tips and words of wisdom that I have seen, mistakes made by myself, mistakes made by clients. These are just the most common ones. There will be mistakes, you will learn from it and move on. And every time you do learn, you get better and better as a real estate investor. So best of luck, happy investing. And of course, if you want to keep learning more about real estate investing in general and the agent side of things, subscribe to my channel, but see you all in the next video.